Hello and welcome to today's live webinar where we cover the ASX investment opportunities in review. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. The technology that I'm using today is our Investor Signals professional member area. You can subscribe to the service for $1,320 for 12 months. If you'd like to know more about it, please visit our website or email or phone me on 1300 614 002. Moving straight into a graph of the US market, and the process for today's presentation, we'll look at the macro backdrop where markets are heading in 2019, and then we'll roll through the ASX 100 model portfolio, and keeping in mind that not everyone's in a position to buy every stock in the model portfolio. We're going to try to narrow down a range of high conviction ideas which will begin to develop in today's recording and in subsequent opportunities in review webinars over the next few weeks. What I'd like to do is just bring into screen a couple of notes, I suppose, that I have that help with sort of assessing that larger macro view with what's going on in equity markets and across different commodities, currencies, etc. So up on screen there is a graph of the S&P 500. No, really just so that's 2 years trend of the S&P 500. In particular, what we want to focus on is the sell-off that equity markets had in the December quarter. It was the largest sell-off since the GFC in percentage terms within a 3-month period. So from a historical standpoint, it'll be a quarter that is well remembered. Interestingly, the correction of 20%, nearly half of that's been recovered now in the first 3 weeks of 2019. So if we backtrack, so end of September, the market was performing well, started to break down, stopped and consolidated at around 10% sell-off, so that sort of 8 to 10% sell-off range, which was still reasonably large. That sort of takes us back to the type of sell-off we had in January. But other than that, we'd gone quite some time with sort of most sell-offs only being around 5% on, as a relatively deep correction. So volatility's picked up over the last 12 months in markets clearly. And then by late November, early December, the markets really let go and sold off another 10% coming into Christmas. The last week of December, we saw a very small recovery in percentage terms, and then by early January, the markets really started to recover. Now, the relevance of this is that from a pure technical standpoint, it's not unusual for a market to run into resistance as it recovers back up at roughly 50% of that sell-off point, and that 50% mark coincides with where the market let go in that December period. So the old adage of old support becomes new resistance. So this is a support level in the market. As it rallies back up, that becomes resistance. So we're getting pretty close to a point where, as a minimum, the rally should pause rather than just keep blasting higher. If we go through some of the global equity markets, so China, what I find interesting here is that China trades on a discount relative to other areas of the market. There's a lot of other regions of the world. There's a lot of bad news priced into Chinese equities, and I think we could be sort of looking at a level that offers good value. So we've been buying the IZZ, which is the Chinese ETF. Hong Kong, probably not quite the same discounted value as the Chinese market, but interesting just to see how strong the performance of the Hong Kong market's been over the last sort of 30-odd years. So just if you're not picking up that time frame, the graph's going back to 1983. So I think there's a pretty strong consensus there that buying the dip in the Hong Kong market is probably a pretty good long-term strategy, combined with adding the discounted value from the IZZ or from China. I think there's something there just to have a think about. In Australia, so looking back since 1992, our market's been on a fairly steady climb. 2007 probably got a bit extended from the mean, reverted back a little bit below that, but you'd have to say that our market is I think in a fairly stable uptrend, and probably a little bit like some of those Asian markets that we looked at earlier. I think there's a strong argument you want to be a buyer of a dip within the Aussie market. Germany, so you can see here over since 1990, again, fair amount of volatility, but being a large export economy, it's done very well as the global economy's broadly expanded. Gold. So we saw gold do well as interest rates came back down post the GFC. And where we're sitting at the moment, sort of a consolidation between roughly, 1,050 to 1,300 an ounce, and it hasn't really broken out of that. Natural gas, we had this spike here that was where a large hedge fund was squeezed. It was short natural gas. They had to cover those positions, and that caused that spike. Nat gas has pulled back, but you'd have to sort of form a view that the support level at nat gas at anything under $3 is very strong. WTI crude, we've seen one of the views that have expressed on the blog has been that oil is a reasonable way to get added leverage to the recovery in the markets, which we've seen over the last 3 weeks, and we think that's mostly played out for now as a theme. But on a 12-month, 3-year, 5-year outlook, we see oil actually trading higher. Now, here's where it gets interesting when you look at the S&P 500. Puts into context really just how strong the run-up's been. Now, a big part of that's obviously been large PE expansion in US technology companies, and that theme is starting to be questioned at the moment. And there were pockets of companies that were just trading on too high PE valuations. Part of this has also been supported by share buybacks, which is driving US equities. But, tax cuts obviously helped. But the actual underlying earnings growth of the S&P 500 is quite healthy. So whilst when you look at this graph, it looks a bit concerning, as we start to see fourth quarter earnings come through at the moment. We've seen most of the large banking and financial stocks in the US report earnings, and they've largely come in line with expectations. One of the concerns around the banking sector is that the yield curve is flattening, meaning that the short end of the curve's as steep as the longer end of the curve, which makes it just more difficult for banks to increase their margins on their loan facilities, which will crimp earnings. So I think that's a theme that's probably likely to stay. So it's hard to see a catalyst for US banks' earnings to really take off from where they are at the moment. Nasdaq. So this is the correction here in tech stocks. So we can see the 2000 bubble burst there in the .com. Here was the 07 correction, and then the tech stocks have had a very big rally since then. So again, if we sort of think back to sort of old, resistance becoming support. So the top of the market last time was around 5,000 points. The sell-off came back just below 6,000. So my view on the US equity markets is we're likely to move sideways, but maybe there's an environment where you just need to be on your toes a bit more with regards to shorting opportunities in the market. If we look at this Aussie market, so this is a table of 2018 sector performance on the Aussie market. So we can see here the healthcare sector clearly outperformed, delivering 19% return, whereas on the other side of the ledger, telecommunications, so mainly weighed down by underperforming Telstra, TPT, financials, which were the banks. So if you're overweight Telstra and the banks last year, you didn't have a very good year with your portfolio. You wanted to be in healthcare, some IT, consumer staples did okay at the margin, but that reflects the low growth. So if you think about Woolworths, Wesfarmers, for example, delivering on average 4%, that's where the need to add covered calls to your portfolio to boost those returns. So instead of getting sort of moderate levels of capital gain and dividend, if you add the covered calls in, you're getting an extra 6% cash flow, or boosting that up to about 10% return per annum. So these low volatility names, real estate investment trusts, your utilities, consumer staples, in some cases your materials stock, especially where they're sitting at the moment, we think that they look quite full value at the moment, so selling calls over those all helps to add to the return. Now, the other snippet that I had here was just one of the themes we were looking at the end of last year was health scope. So that from time to time we see these takeover opportunities in the market, and we were fairly confident that the takeover bid for HealthScope would proceed. So we've been buyers of the stock anywhere from $2 to $2.10. We've been in and out of it a couple of times. It's been a fairly drawn-out process around the takeover deal. But it looks like that'll be formalised. So there's a Brookfield Capital Partners, the Canadian company, will look to formalise their takeover bid. They've been finalising due diligence at the moment. And that'll be likely around $2.44 at a cash price per share. So that story really played out for us at the end of last year, and we should see that finalised over the next few weeks. If you'd like me to email you those macro graphs, just send me an email and I'm happy to reply with those attached and discuss further if you like. All right, so up on screen, what we do here is go into the watch list. Now, for me, I come down here to custom list number 1. You can add whatever codes you want into these lists. Custom list number 1 for me gives me my macro graphs. So I start by clicking on the NASDAQ, and then I can toggle through them and have a look. So what we want to focus on here is that the market, so this is the December quarter sell-off that we're looking at, and again, capturing that point that the market's getting close to 50% of that sell-off, likely to run into some resistance. So the NASDAQ may have another 100, 200, maybe even 300 points back up to, say, 7,500, but I'd expect this rally to start to tire within the next few sessions. And then, interestingly, the catalyst behind that may be that towards the end of this week and certainly next week, we start to see the multinational companies report from the S&P 500. So the US banks have reported so far, came in line, hasn't hampered the rally in the market, but maybe the multinationals where I have exposure to Asia, we may start to see slightly softer earnings there. That may be the catalyst for the rally to pause. So we'll watch that and continue to comment on the blog. So NASDAQ, I think, getting close to resistance. S&P 500, the same thing. There may be another 3-4% rally, but probably getting to a level where it runs into resistance. Dow Jones, if I have time in today's recording, we'll quickly toggle through the top 30 stocks in the Dow just to give you a bit of a picture as what's happening there. But the Dow may be back up at around 25,000 points, starts to run into resistance, so another 1,000 points above where it is at the moment. And then interestingly, our market, we've got the first of the major indices with a sell signal. So we've got a lower low, lower high, and an algorithm sell signal. So we start to take a more cautious approach to asset allocations in our domestic market, lock in profit where we can, and that'll be part of the focus as we go through today's recording. STW, which is the Spider 200, so we haven't had the sell signal here yet. We've had it in the XJO, but not in the STW, so we'll continue to watch to see if we get another day or two of the market moving higher, probably mainly driven by the US, and then whether we get a sell signal in the STW, and then that's the NASDAQ ETF. So again, we don't have the sell signals in the ETFs. The IVVs, the S&P 500, so no sell signal there, but first warning, if you like, that we've had the signal on the XJO. The two US ETFs that I might draw your attention to that you probably haven't seen me cover or comment on in the past is the IJR, which is the small cap, so it gives you exposure to US small cap stocks, and then also the mid cap, which is the IJH. So we've had algorithm buy signals on these recently, and they're both performing well as part of the ETF model portfolio. And there we are, back to the NASDAQ. Okay, so to start the review of the ASX, what we're going to do is click on Model Portfolio, and I'll just quickly show you how this works. So what this is a model portfolio that's automated under our algorithm model. You can select whether you want to see the stocks that are in the top 20, the top 50, the top 100 model, etc. So the reason why a stock is added into this model is because it's making higher highs and higher lows, or it's been added under the algorithm signal to suggest that strength is developing or going to be developing. So out of the top 20, these are the stocks that are in the model at the moment. Interesting, the only of the major four, we've got ANZ in the portfolio. The other banking stocks, Suncorp, which are obviously partly insurance or more insurance than it is banking. We've got IAG in the portfolio. Macquarie's in there, which has been a good contributor. And CSL's obviously been the best performer within that healthcare space. IAG's done well. BHP was recently removed, so these are the current holdings up the top. To have a look at what's recently been removed, I like to either arrange these by date, so clicking to get the most current date to the top, and it shows me that South 32 was removed at a slight loss, BHP was removed at a 50% gain, Westpac at a 3%, Rio at a 38%, etc. So that shows you the history on the model portfolio there. To make sure you're getting emailed the notifications when a stock's added or removed from the model, that envelope on your version needs to be green opposed to grey. So when it's green, it's turned on and you'll get emailed the adjustments to the portfolio. So the top 50 model, the other way to look at it is come in here, click on the days held, get the least number of days to the top. So that tells me that the most recent stock added to the top 50 model was QBE. It was added at 1084, now trading 1106, which is up 2%. And then it keeps track of the accumulated dividends from the time it was added to the portfolio. So if you can go down and have a look through the performance of those, what we're going to do today is run through the holdings in the top 100 model. So I'm going to put these in alphabetical order, and we'll go through and start having a look at these. And I'll comment on the ones that were likely to make their way in as a more of a high conviction portfolio. I'll keep notes on those today, and then I'll update the table link, and that'll be included in the replay of today's webinar. And I'll speak a bit more about that when we wrap up the session. All right, so moving through these, ALS, not doing anything there at the moment. Ansell we like, but I think reflective of our concerns that markets are getting close to resistance, even though we consider Ansell a terrific company, good value, 8% earnings growth on a roughly 3.5% dividend yield. You can see in today's price action that the stock's running into some resistance. So if you're owning it here, sell covered calls up at around $24. If you've bought it at lower levels, I think in line with generally the view that the market's nearing some resistance, and it doesn't hurt to lock in some profit. But we'll make a note of Ansell, and that'll be one that we'll continue to cover in the next sessions of this webinar. So ANZ, I think the Aussie banks, I think the rebound's largely complete in the Aussie banks, so running into some resistance. ASX, this has been an alternative to being long the Aussie banks, so it trades on about a 3.5% dividend yield. Fairly expensive up here, and you'd want to be selling covered calls over it to enhance the return. Illumina, not there at the moment. So again, these are all stocks that are in the ASX 100 model portfolio. They may have been in there for a year, 2 years, 4 years in some cases. So it all varies. Brambles. The interesting story here with Brambles is we're probably only 12 weeks away from getting further clarity on them separating their plastic pallet pooling business. The stock's reasonably expensive as it stands at the moment. And one of the strategies could be to take profit where it is at the moment, wait for the separation to occur, and then maybe build up a position. I expect the plastic pallet pooling business may actually have better growth profile than the more traditional timber pallet pooling business. So that's something that we'll continue to comment on and review over the coming months. Car sales. So this is a stock that I like. I commented on the blog at the end of December that at around $11 the stock was good value. We had it as a strong buy conviction on the blog. The stock's now trading $12.25. Look, car sales delivers about 8% earnings growth. It's on about a 4.5% dividend yield. A lot of these technology companies got hit in line with the sell-off in the US, and they've really just got a little oversold. Car sales probably could trade up to $12.50, $13. Don't see it doing too much more than that in the absence of any further news out of the company. So we're coming into Australian earnings season, which will get underway next really at beginning of February, probably for the most part around the 10th of February, the result numbers really start to pick up. Charter Hall property, real estate investment trusts have done very well especially as bond yields have pulled back over the last 3 months in the US. So, and I think that sector continues to do well, but arguably getting a bit expensive, and you want to be selling covered calls to drive the extra returns. So CIMIC, this is another stock that we like, but again, reflective of sort of where the market is at the moment. We think it's probably likely to mainly trade sideways, but the upcoming earnings result should be a catalyst to support the valuation there at around $45, so we don't mind CIMIC. Computershare. So this has been in the model for a little while, but my view on the stock is it's fairly expensive as well on a PE basis. So Computershare trades up at around 19 times earnings on a 2.5% yield. So I see it mainly moving sideways. CSL, so we continue to like this name within the healthcare space. Put some numbers on this. CSL trades at about 30 times earnings and only on about a 1.5% dividend yield at the moment. So again, mainly trading sideways. Think about selling covered calls. Crown, we like. So if we think back to the last earnings result, we saw a substantial pickup in VIP gaming revenue, but the company acknowledged that top-line revenue growth across their portfolio of casinos was fairly limited, and the necessity to focus on cost control was a highlight of sort of upcoming earnings growth. Over the next 12 months, we'll start to see more developments around the Barangaroo, the Sydney casino, but for the most part, it appears to be running on schedule there. But so Crown, we have trading on around 18 times, around 18 times earnings, and again on about a 3.5% dividend yield. So 12.50 covered calls will help to drive better returns there on that. Not doing it there in Dulux. So Downer EDI, again, this was a stock similar to CIMIC. It's in the infrastructure space. With the stock rebounding from 6 up to between 720 and 750, we feel that that's a range that you want to be looking at taking profit on that. Dexus within the property space. So if we look at what the algorithm, so where it switches from sell conditions up the top here into buy conditions, that's the point that is added into the model portfolio. So Dexus has done well since being added. Evolution Mining. So one of the themes that has delivered good returns for the model portfolio at the end of last year was being along the Australian gold miners. They did very well, probably one of the better performing areas of the market in the December quarter. So if we look at Evolution, it was under sell conditions, then it was added into the model portfolio at around $3 and continues to push a little bit higher. Flight Centre, some level of support developing here at around $42. Goodman Group, so property trust. Goodman's expensive relative to the other property trusts. It does deliver a slightly better growth profile. They're growing earnings at about 8%. They're really a global logistics property trust, so they focus on distribution centres for, in a lot of cases, these online fulfillment centres. So it's a very attractive growth business model within the property trust space, which is why it trades at a slightly higher multiple and a lower dividend yield, but certainly a terrific growth profile there. If we look at it, it's switched from sell conditions into buy conditions, and it's been in the model since around that $10 level. GPT, pretty close to full value here. GPT will grow earnings around 5%, just under 5% dividend yield. Owning it here and selling covered calls, don't see it doing too much more to the upside. So here's HealthScope, and we've traded this a few times over the sort of last 6 months, but most recently it spiked down to around $2 in mid-December. And then as we've seen comments out around the takeover bid likely to be finalised. The stocks rallied from 210, and we've just started taking profit at 240, 239, 240. The takeover cash bids 244, could end up as high as sort of 255, 260, but no guarantees on that. So we've just taken the profit on that for the time being and have a look around at other opportunities. So Insurance Australia Group, we continue to like IAG. So add that one to our list. At around the $7 level, we see that as good value. Adding a covered call up at around $7.50 makes sense. Incitec pivot, so again, went from sell conditions into buy conditions. It's been added into the model. We actually traded this where we bought it at lower levels, and we've just taken profit on a short-term basis on that at the moment. JB Hi-Fi, so again, all these stocks are in the model at the moment, and JB Hi-Fi finding support there around $21. So what I encourage you to do is go into the members area and toggle through these stocks yourself and have a look at some of these high conviction ideas as we start to finalise those over today's session and next week. James Hardie, so within the property space, James Hardie, Lendlease, CSR, Boral have all been hit very hard as we've seen significant slowdown both in the US and in Australia. Now, the catalyst for that in the US probably really was as interest rates started to push higher, consumers put on hold sort of any decisions around new loans, so you started to see that flow through to a slowdown in housing construction data. It appears that we're just starting to see the beginning of some of that restriction sort of ease there as US interest rates have backed off again, and consumers in the US have a little more comfort that there's not going to be a really aggressive rate rise cycle that the market was fearing in 2019. So maybe most of the bad news in these building stocks is priced in, and that's just a theme that I think you should sort of stop and have a think about and keep an eye on those names. And again, I'll continue to update you on the blog regarding that. Now, Lendlease had the overrun on the engineering project in Sydney there. The final number to Lendlease could be as high as $700 million. The market's looking for some comments in the upcoming earnings result where maybe Lendlease will look to spin off that engineering division. If that happens, I think you could see Lendlease rebound back up to around $15, $16 quite quickly. So we're going to put Lendlease there. I think it goes into a higher risk group, but I think that's one that you could even think about buying call options ahead of the earnings result as a way of getting exposure there to Lendlease. Magellan, I think that's getting a little bit expensive up here at $28, $29. Medibank, so this is one that I commented on the blog as we saw it sell off at around this $2.30. There was a bit of a perfect storm there with Medibank, and the stock fell down at very low valuations. At around 270, to me, it's back to fair value. The company will have a hit to earnings of about $30 million from losing the Australian Defence Force contract. So that has to show up. And if we look back over the recent earnings results, they had fairly moderate levels of growth. So at around 270 puts the stock back on just above a 4% dividend yield. And we're assuming fairly low to maybe negative earnings guidance over the next 12 months. So back up, so anything above 270, I think starts to run into resistance again for Medibank. Macquarie, so this is one that we had the algo buy signals on. Macquarie's doing a terrific job of delivering earnings growth. So they're guiding towards at least 10% earnings growth over the next 12 months. But the stock's sort of running into resistance based on sort of where our view is that equity markets are heading at the moment. Northern Star, so this is probably the better performing stock in the model portfolio, or the best performing stock in the model portfolio. So it switched from sell conditions into buy conditions back in 2015 at around $1.90, now pushing up $9. And we've had a series of higher highs and higher lows have continued to support that. Aurora, so this is the packaging business that was spun off from Amcor at around sort of this 320 level, looks okay value, but not stock that we're too active in. Now, Oil Search, Santos and Woodside were our preferred equities to get exposure to that recovery in oil that I spoke about at the beginning of today's session, which was really the theme there, that we saw oil rebounding in percentage terms probably stronger than the equity index itself, which sort of led us to look at the oil prices as a way of getting leverage to that. So Oil Search and Santos, I think now the argument is, rather than buying oil itself, you want to buy the stocks because you're getting access to the upcoming dividend, which will, so Oil Search, Santos, Woodside are the preference there. Oil Search may trade up to around $8, but not too much more from where we're at the moment. QBE was one of the stocks that was most recently added to the model portfolio, and we can see there made a low of around $9.50, now pushing up towards $11. It'll be an interesting one to look at the upcoming earnings result, but for me, pretty close to full value again at the moment. Cube Holding, another recent addition to the model portfolio, so it was added there at around 230, now trading 260. REA Group, so trades on a fairly high PE, corrected off the back of the US technology sector coming off, but not a stock that we're too active in at the moment. ResMed reports their earnings results next week. If we have a look at this, it was added into the model portfolio at around this $14 level, now trading $16.40. But I'll comment on the blog next week as the earnings results come through for ResMed. Reliance Worldwide not doing there. Centre Group, so this is the Australian Westfield business, trading about 4% earnings growth on a 5% dividend yield, owning it here and selling covered calls. The stock's supported by the company doing a share buyback, so it's a good income strategy for portfolios owning it and selling the covered calls. Seek, we're going to put that one onto our list as one that we'll come back and revisit. Seek at around $17.50 looks okay value to me. Sonic Healthcare, that goes on our list. So we like this. We've seen Sonic make an acquisition in the US, which will help to broaden their footprint. So over the last sort of 5 years, they've expanded substantially into Europe, and now we're starting to see them extend that footprint into the US. Owning it here and selling calls up at around $24, I think, is the strategy you want to think about there with Sonic. Santos, a little like Oil Search, maybe a little more upside up to $6.50. Woodside looks close to full value, but maybe Oil Search and Santos have a little bit more left in them as part of this rally. Based on my long-term view on oil prices, any pullback in Oil Search and Santos over the next couple of weeks would use that as an opportunity to reset long exposure there. You can see here what the algorithm model's doing. The stock's gone from a downtrend, making lower lows, lower highs, built a new uptrend, and now we're getting these confirmations on the buy side. Suncorp, so this is one that I've spoken about. So we're minor buyers of this at around this $12 level. Suncorp trading back up to around $13.50, I think, is back near resistance. TPG Telecom, Treasury Wine, so we like this. Treasury should deliver at least 20% of earnings growth. And we see it pushing back up to around sort of that $16 level, probably not too much above that at the moment. But the growth at reasonable price, which is a theme that I've commented on the blog, we've looked at Aristocrat Leisure, we've looked at Seek, we've looked at Treasury Wines, car sales. So some of these growth names are ones that I'll include in the notes, and we can continue to look at those as an opportunity to repurchase those on any minor pullback that we get in the market. Sorry, just jumping back. So Vicinity Centres was added to the model portfolio around $2.50. Wesfarmers, so we've seen Coles spin off from Wesfarmers. The latest earnings update from Wesfarmers showed that Kmart's earnings were slowing, and had actually moved, I think, into negative numbers, and Wesfarmers' earnings were relatively flat. So it's hard to see where the growth for Wesfarmers is going to come from at the moment until they articulate whether they intend returning capital to shareholders or making a large-scale acquisition. Either way, Wesfarmers and Coles, we see them both as an income line for portfolio, where owning them and selling covered calls is a way of sort of driving the extra return on top of the current dividend yield. Whitehaven Coal support there at around 440. Woolworths looks a bit expensive here. So pushing up over sort of 21 times earnings, 3.5% dividend yield. I'd like to see the upcoming earnings result to have confidence that where fair valuations sit. So certainly either taking profit or selling calls over Woolworths. Woodside Petroleum, so we've seen this rally from $29, $30, which I highlighted on the blog that there was a buy within that $29 to $30 range, now pushing back up to 34. Between 34 and 35, it runs into resistance. And there we are, back to the beginning. All right, so thank you for listening into today's recording. What I'll do following today is I'll update the table, which will have the beginning of tracking the high conviction ideas, and then in next week's recording we'll start to narrow those opportunities down as an action plan and keep you updated via the blog. I did say that if I had time I'd cover the US stocks, so let's finish with a quick run through the Dow top 30. So to do that, we go watch list, we come in here, select Dow Jones 30, and let's just quickly move through these. So if you haven't seen sort of the picture following the correction in the US market, you might find this interesting. So Apple is a stock that Warren Buffett, Berkshire Hathaway's become a large shareholder in. Had a substantial correction as iPhone sales slowed in China and general profit-taking correction in the technology area, etc. So Apple corrected from 240 down to 150. American Express, again, a stock that Warren Buffett owns a lot of, made a lower low, so we may actually see an algo sell signal in the coming weeks, but for the time being, it's in the model portfolio, but largely moving sideways. Boeing was just removed from the model, so after it correcting down to 290, rallied back up around 360, the stock's been removed. Caterpillar was removed from the model last year, and we're seeing that sort of lower low, lower high pattern there. Cisco Systems doing very well in the US, but tracking sideways at the moment. Chevron in the model portfolio. Energy names seem in the middle of a level of recovery. Disney, you may recall that Disney's made a takeover for Fox in the US. And that'll give Disney access to a lot more content. We'll start to see Disney develop a subscriber channel business model to compete against Netflix. And it's obviously a terrific business. Dow DuPont, so we actually like this name. This is one that we've been buying on the lows here. See it pushing up to around sort of maybe as high as sort of $60 to $65. Goldman Sachs, so a big correction here. Down from, say, 280 down to 150. The stock's now rebounding back up at 200. Interesting that we've got another algo sell signal, so see it running into resistance within a few dollars from where it is at the moment. Home Depot, that's under buy conditions. IBM is under buy conditions. Intel, so strong uptrend here, was supported around 45, so that's in the model. Johnson & Johnson, so we've seen that sell off. To me, that looks like it's kind of breaking down a little bit and maybe making low and lower highs, so we'll watch that for the next algo sell signal. JP Morgan, probably the best banking franchise in the US, so making higher highs and higher lows, that's in the model. Coca-Cola was a recent addition to the Dow Jones model portfolio with a buy there at around $45. McDonald's has been removed from the model. Trades on a fairly high PE, McDonald's. 3M, so big industrials like 3M, Honeywell, they've sold off quite heavy, but these are the names that we want to watch out for in the upcoming earnings result towards the end of this week, and next week you'll start to see those big multinationals report their earnings result. Merck's been recently added into the model. Microsoft has been added into the model. Microsoft's probably the second biggest player in the cloud computing space, followed by behind Amazon. So Amazon's the leader. Nike's done very well, so higher high, higher low. It's in the model portfolio there. Pfizer Group is in the model. Procter & Gamble, a little bit cautious on that at the moment. Travelers is in the model, so a big insurance group. United Health, which is their health insurance company. So this is one of the better performing stocks in the US model portfolio. United Technologies, which is a terrific company making higher highs and higher lows. So what we're thinking that the pattern that'll play out in some of these names is after this correction, we're probably likely to get algorithm sell signals in a number of these stocks that have made lower lows and are now rebounding. Different story here for Visa. Visa has a strong bullish structure in place, so expect that continue to move higher. So does Verizon, so in the telecommunications space. Walgreens was recently added to the model portfolio. Walmart is in the model portfolio, so you're starting to see Walmart build a more competitive online strategy to compete with Amazon. So you're starting to see sort of an old brick and mortar business there, really sort of morph into a true competitor to Amazon. ExxonMobil, so we're seeing that recovery in the energy prices. And then there we are back to Apple. So if we want to have a look at just those stocks that are in the Dow model, so that just then we toggled through all 30 stocks that are in the Dow Jones itself. Now what I've done is gone across the model portfolio, gone down to Dow Jones, and we're just going to have a look at the stocks that are actually in the model. So out of the 30, there's about 20 that are actually in the model at the moment. And if we sort of have a look at them from alphabetical order, so Apple, American Express, Cisco, Disney, Dow, DuPont, Home Depot, IBM, Intel, etc. So you can go through and just have a look at those. If we want to have a look at what stock was most recently added, so Coca-Cola, Merck Group, if we want to have a look at them from percentage terms, the worst performing stock in the Dow model is IBM. The best performing stocks, United Health, Microsoft, Nike, etc. So again, these are the stocks out of the 30. These are the ones that are in the model portfolio. Now, Investor Signals does offer international broking now. So if you'd like to have a chat about working with me to manage an international share portfolio with a particular focus on US stocks, then that is a service that I'm able to provide. Thank you for listening in. Again, I'll update the notes and it'll be an attachment below the replay of today's recording, and we'll start to drill down into specific high conviction buy-sell ideas over the next few weeks. Thank you.